Take your seats, let's regather and turn our session, which is what are the upcoming risks and opportunistic themes for the next 3 years, everybody. Looking forward to the next 3 years. This topic is particularly pertinent as we're going to navigate an ever-evolving economic landscape filled with uncertainties. And in the next few years, investors are going to need to be vigilant about potential risks that are stemming from global economic shifts, regulatory changes, and market volatility. At the same time, there will be significant opportunities for those who can identify emerging themes, such as technological advancements, sustainable investing, and shifts in consumer behavior that could drive growth in various sectors. With valuations now turning expensive and markets looking for a breather, what should investors expect and look out for? So, ladies and gentlemen, we're really excited to have in our midst Mr. Nilesh Doshi, the founder of Green Lantern Capital LLP. He is a technocrat, engineer, and researcher with over 30 years of experience in identifying macroeconomic trends and high-quality companies poised to benefit from them. His impressive track record includes notable calls that have generated returns of 5 to 10x. And as the CEO and managing partner at Green Lantern Capital, his objective is very clear: to create wealth for everyone. So let's welcome Mr. Nilesh Doshi to share his invaluable perspectives on the risks and opportunities that lie ahead in the evolving landscape of investment. Ladies and gentlemen, let's welcome Mr. Nilesh Doshi. Welcome, sir.
Presentation will follow, right?
Yeah. This is the. Do you want me to change or change the slide?
No, I can change.
Okay. If you want to go to the next slide, this one.
This one, right?
Yeah.
Okay, that's fine.
And go back is the niche wala.
Go
You
back.
want to go back?
And this one is switch off.
No, this must be the pointer, but do you need...
Yeah. Thank you, Kamal and the team. Thank you all for inviting us over here. Kamal, actually put me in the post-lunch session because normally we tend to sleep after such good lunch. So I thought, let me keep you awake with what we see and what's unfolding in the global landscape and including our economy. Why I use this word global landscape and economy is that typically investors tend to forget that equity markets are always related to economic activity and how the businesses are going to pan out as we go forward. So I think that's very critical. Just to give you a little snapshot, I don't know everyone knows what is Green Lantern. So I started this business about 6-7 years ago with another colleague of mine, and then we expanded from there. Prior to that, I was the head of research on the sell side with Edelweiss and other broking firm, and my colleague was fund manager with Reliance Mutual Fund and FII. So this is how we started. Now we are a 4-member core management team, and then rest of the staff for doing other operational and compliance and other legal activities. So our objective and our experience curve is always through research. We are a very strong research-driven organization and not momentum-driven or any trading perspective. We are always based on the business analysis, and we invest only through a landscape of business. We have 2 schemes, so I've just, so these are we are the 4 who in this core team. Okay, so I'll quickly run on what we exactly do. We don't buy stocks because it's going to go up. No. We invest identifying the business which has a differentiation, which has a potential to grow substantially, and available at an extremely favorable risk-reward valuation. We don't chase PE. We don't buy because the PE is 60 and it's going to go up at 80. No, it's clear. At the same time, we don't buy whether it is a 4 PE and therefore we should invest into, which is a very cheap stock. No, our clarity is clear. I mean, very simple, that the business has to have a differentiation. It could be a cyclical business and the cycle is turning in favor of the business. fair enough. We have no objection to that. But we should be able to recognize that the cycle is turning. And the balance sheet is going to turn, business is going to do well. So the first point, as I have said, is all what I have said gets merged into margin of safety. That the business is available where no one is probably looking at the business. And if we can identify based on our macroeconomic learnings, based on our experience curve on all of the sectors, whether this business is ripe to move over next 2 to 3 years. Long term we will do later on, but this is how we start our investment process. We will not buy just because business is good, available at 4 PE, and at some point of time in life the cycle will turn. We never do that. Because though we all say it's a very long term, and I'm okay with the long term, but I've seen if the other stocks keep moving up and your stock is not going up, you will always have pain. So margin of safety is our core hypothesis of investment. And as I said, business focus. So business is very critical for us to invest. And then the last is we keep regularly interacting with the management, the competitors, and keep tracking how the sector is unfolding. So we have 2 schemes. I think Kamal and team must be even communicating with you. So one is small and mid-cap, which we started about 6-7 years ago. Though the name suggests it is small and mid-cap, but we still have a reasonable large cap also in that. So it's typically a flexi fund, you can say, or a multi-cap fund. And we are not averse to investing into large cap. Like we have in the cycle invested in even ICICI Bank at 200 rupees or SBI. So we are not averse to anything. But we gave this name because when we started, we felt that a very large money is generally made in small and mid caps because those have a potential to grow multifold if the cycle is in favor and your hypothesis is right. The other scheme what we have is for people who cannot absorb volatility, because small and mid cap would generally behave in a step function. So there would be a volatility in the portfolio in small and mid cap sectors, whereas large mid cap to large cap is less volatile, and therefore we started that scheme in 2020 around COVID time. Just a snapshot of our return. The small and mid cap fund has given a return of 5-year CAGR is about 49% post our fees, and 1 year we have been at 78%. So this is on the growth side. And in the alpha fund, we started about 4 years ago. It's also pretty similar, 47% CAGR return. This is pre-tax, but post all expenses. And these are various newspaper, because I think we have been in top 3 performing PMSs in this country consistently over the last 5 years. So most interesting question today is, and I have been asked by many before, during lunch and before, is what are we looking forward? And I'm sure you had a very nice session from some of my peers pre-lunch, and long-term India story is, people also talk Amrit Kal, 2047, and then how do we go through that? Whereas we are coming from a different observation in the market. So and Kamal, when I talked to Kamal that I was a bit hesitant actually to address investors at the current environment, which I'll share with you. And I found Kamal has been very professional, and he said, no, we would, I want you to, whatever is your view, but I want you to inform investors, because investors should be protected and investors should be aware while taking the decision. And so nice of him that he was open to the discussion which I wanted to do it today. So I'm using word 12 to 18 months. I'm not looking at 5-year and 10-year, because over the last 20 years of my journey in this market, I don't think anyone has a crystal ball that what market is going to be 20 years down the line. Forget 20 years, no one knows even what's going to happen after 1 year or 2 years. I worked with very large companies prior to I got into equity, large MNCs, large corporates like Pidilite for many years. Praxair in Bangalore, I worked for 4 years as a very senior level. And my industry experience also tells me that no management would know what's going to happen even next day, whether consumer is going to buy or not. So it's fine that we do talk of long term, and I am for long term, but the journey is not straight. So that's what I wanted to take you through today. There are few positives I wanted to bring. I'm sure all of you are aware, but I thought I'll take you through the background so that what I want to convey you would be easy to understand. So what we're seeing is US is still a good growth as of now. Employment is at, unemployment is very low. And inflation is slowly cooling off, and that's what we saw. Federal Reserve cut 50 bips interest rate first time in September. Whereas on the other side, we look at China. They are trying to stimulate their economy, but I think it's in a big mess. The data what we understand is that there is a huge problem in the economy, and plus their demographic is also changing. So age profile is also increasing. And mean age is today, I think, 43 in China. So that economy is getting into a structural issue. How they will come out needs to be seen, but yes, there is a pain in China. ECB also is trying to cut the rate and stimulate the economy. And some positives of India, which, just to recap, is today we are at about $3.7 trillion. Our GDP per capita is $2,700. And with the current election, though it is a bit coalition, but we think the political stability will remain. It is manageable to a large extent. So these are bit positives on India side. The government is continuing its policy reforms with the PLI scheme and Atmanirbhar and manufacturing in India. So there are a lot of positives from the government to push manufacturing in the country, especially in the area of engineering goods, defense, telecom, semiconductor, renewable energy, chemicals, etc. Plus infrastructure spend is, we all see it's still continuing. But there are some imbalances which I'll address going forward. And we see in area of engineering goods, we see that is a sector we see still good demand locally, as well as surprisingly for last 2 years, the demand from developed world is rising. On the renewable side, on the power transmission side, on the capital goods side. So overall, we look at India, we are, I would say, as I said, we are positive or probably small oasis in a desert. So we are in a very, very challenging and difficult world, but we are still growing at least at 6% growth rate on the real terms. And our inflation is under control. And I'm sure a lot of investors look at our current account deficit, which is also basically at the moment is under control. And there are people who are projecting it to become positive going forward. So we have a lot of stability on the macro side and in political side in India. But probably the environment in which we are is extremely challenging. So let's attend to what are the challenges. So the challenges what we see is we are seeing war at two fronts. The Ukraine-Russia is not stopping, and now we have seen the Middle East issue. And probably 2 days ago, we have seen North Korea also started some disturbances between South Korea. In fact, they demolished their own roads and bridges connecting to South Korea. So nobody knows why, but that's the first bit signal. And on top of that, we have geopolitical tensions and instability which is rising. Trade war protectionism is going to continue, irrespective of who is the president coming in US. And in certain countries like UK, we have seen recently migrant issue. In Bangladesh, we have seen political instability. So what we are seeing is we are not in a world which is so good what probably we have seen between 2000 to 2020. That was a bit better world, or maybe 1980 to 2020 was a much better world. On top of that, what we are observing is deglobalization and reindustrialization. Between 1980 to 2020 was more or less globalization, outsourcing from other countries. Now we are seeing a reversal of the trend, especially on the very sensitive areas like semiconductors, batteries, lithium, mining. Those are the areas which are very important to mankind going forward. We cannot live without semiconductors today. We cannot live without mobile, without internet. And everything is resting on these technologies. We cannot even imagine if tomorrow, let's say for 10 days or 20 days, the internet collapses. I don't think we can imagine. You go to your bank, you will not get to know what's your bank balance. So we are in a world where we are dependent on these technologies. I'm not against it, they're positive. But that is forcing reindustrialization. Everybody wants to create their own source and self-sufficient supply chain dependent on these technologies. Now not dependent on China or other economies. Technological innovation is also rampant. The speed at which the things are getting innovated, on a financial side, it confuses every fund manager. You don't know whether this technology will survive after 1 year or 2 years. That's the speed which we are seeing across the board, whether it is renewable, whether it is solar, wind energy, batteries, any area, semiconductor, the change is phenomenal. The way of doing business is changing across. And we are seeing entrepreneurs coming with different models to actually capture these opportunities. And we are also seeing mom and pop stores kind of people have to adopt to this line, maybe aligning with Zomatos and Swiggies of the world. Other challenge what we are observing is the rise in bilateral trade. I'm sure as a common people, we don't understand the potential of how this is going to change the landscape in the world. But this is a starting point. It will take up many years to really unfold in a very seamless fashion. But this is a first signal that the Asian economies are trying to stay away from using dollar, doing trade between the two countries. Like India will trade with Russia in ruble. In the past, you were trading in dollar, and therefore dollar has to be routed through the American system. Therefore, they know every trade of yours, which is now changing slowly. So the dependency on dollar is declining very slowly. It's not going to happen overnight. And that is also a big challenge to US to maintain their hegemony of dollar. So let's see how it unfolds. And Japan and Europe, apart from the economies are slowing down, their demography is also in a declining, very fast declining. So those economies probably are in a structural slowdown, which I don't see how they will come out, at least over a decade. It's going to be a painful process. Now, let's come to US. One of my friend in Edelweiss had done a very nice survey. He's an economist, and he said that the correlation of Indian economy with US economy is extremely high. And he has all the data to support that, but this is what he has been saying for last 10 years. And what we observe in US is on one side we see very good data, on one side we see positive actions from the Fed to reduce the interest rate to let the economy becoming normal, then very expensive. On the other side, there are structural cracks in the balance sheet. So the one is the fiscal deficit. After many years, US is now at a stage that their fiscal deficit is almost 7-8% of GDP. And this is not going to go down. This is a structural issue, and this will keep on rising. If interest rates continue to remain high, this will increase at a faster pace, but this is a structural crack in the system. And therefore, US will, as a government, will be a largest borrower of capital to support their existing structure. Forget about the growth of US economy. And on top of that, they have been spending billions of dollars for Ukraine and Israel war, which is going to add on the fiscal deficit. There is a lot of stress in the commercial real estate in US. Let's see how it unfolds. So the question arises is that 1980 to 2020, we have seen a declining interest rate from world over and from US, starting from US. From almost, I think, 14% at the peak to 0 in 2020. So we have continuously seen loose monetary policy from US, and US was the largest supplier of capital to the world, being the largest importer. The dollar was moving out. Plus, US corporates went big way into creating manufacturing bases in China. Later on, they have come to India, Vietnam. So we have seen a huge capital outflow from US over the last 40 years with falling interest rates. So as the yield goes down, the ability to take risk with people always rises. The positive was that it didn't create inflation, but it created asset inflation. And we have seen asset prices across the globe. Last 40 years have been rising till 2021. After 40 years, they had to spike the rate from 0 to 5%. So the question is US growth rate is a structural issue, or will they solve it with prudent measures? If they want to solve it with prudent measures, then it will be a very painful process. Because $35 trillion of debt rising at $1.5 trillion every year. In 10 years, probably they will have $50 trillion of debt. And probably their GDP would be at $26, $27 trillion. So can they survive? How will they manage it? If they want to manage it prudently, then it's going to be a pain internally. So we need to see how things pan out. So keeping this background in mind, our thinking is that, and some of the anecdotal data which I want to share with you is, our exports for last 3 years, growth has been practically zero. Nobody is talking of that. We're talking of CAD. CAD is good, but the internal of CAD is that your exports. And why your CAD is zero? Because your imports have not gone up, because we were beneficiary of Ukraine war, which we could buy from Russia at 30% discount. So we are the largest importer of oil. We all know that. And during those periods, even the import duty on gold was so high that import of gold were a bit under control. What we are seeing is also that corporate revenue growth, if you look at BSE 500 stocks, it is a single-digit growth over the last 5 years, which is not good. The equity market is expecting that earnings to grow at 15% year over year, whereas actual corporate earnings growth has not been good over the last 3 to 5 years. It's sub single digit, I mean, and if I adjust for inflation, it is relatively low. And the another critical data which I'll take you with I have some charts also, is the wage growth in private sector is also, which peaked at 25% kind of a level in 2021, at 6% to 8% level, which is not a good thing, because you need earnings to be available in the hands of common man to spend. And probably that could be the reason that, I don't know whether anyone noticed 2 days ago, Bajaj Auto post-result communicated that the sales in the festive season, because Navratri is a very good season. Normally people buy vehicles in Navratri, Diwali. The Navratri sale was 1% growth only YOY, which was, and that's the reason you would have seen Bajaj Auto stock down 11% next day. So the consumption is being seen declining, and we have the data. And probably one can correlate because the earnings growth is not happening, which is at a single digit, which is not good. On the valuation side from Nifty, as she explained in the beginning, is I'm not here to scare you, but I want investors to be aware where we stand before taking any decisions. Nifty is not very expensive. So when I look at Nifty basket, we are 23.5 times forward. Even if the earnings decline, we have a large component of banks in Nifty, and the bank generally don't trade at 60, 80 multiple. They trade on the book value, and most of the banks are at between, barring few banks, private banks, most of the banks are at between 1.5 book. So Nifty per se is not showing a signs of any major concern. But if the hypothesis of 12 to 15% earnings growth, which is a consensus for next year, 2026, if that is challenged, probably we'll have to relook at whether this comes under radar. But major, I would say, overvaluation or extremely high valuation is seen in small and mid caps. And for a developing economy to have an overall market cap of entire basket of stocks versus your GDP, which is, I mean, Warren Buffett's favorite indicator, which I have learned, like everybody always talks of his favorite indicator. So he always gets scared when that ratio goes above 125%, wherein, and that too for a developed world. Here we are a developing economy, we are currently at 150%, which was the peak we have seen in 2007. Some of the phrases or narratives I wanted to touch upon to educate or to share how we think. We have a belief in the market that don't time the market. Whereas we, as Green Lantern, have a different approach. If you buy based on the valuations, revenue growth, earnings going to come, and you sell based on your hypothesis that now the growth rate of revenue is going to taper, earnings are going to taper, I think in turn you are timing the market. You are timing the stock, and that is a must. So, or a large money is made. So, when we think long term, one thing we must keep and bear in mind is that markets are not linear, and markets can correct, which can be a very painful. Then people also say that market always crashes, it then corrects and it bounces back. Yes, that's a pattern, but that's not the way to invest. If you think market is going to correct, then have patience, wait for the market to correct. Because you don't know what's the bottom, where the correction will stop, and then where you should enter. And if you believe that, no, I can withstand the correction, I don't mind it, then one can look at investment at that point of time. But in real world, that does not work. The moment stock goes down by 30%, I'm sure people will start shivering. And we have seen that in the past. And finally, we have another terminology going on today in the world is liquidity. A lot of people believe that liquidity is not going to dry. Liquidity is ample. And I have a lot of money. I want to invest. Our learning curve says that liquidity is a function of greed and fear. If the fear sets in, the liquidity will withdraw like blink of an eye. And this we have seen in all the markets, in all the past. So we should keep some of these things, complacency, the ability, not I would say ability, but to accept if there is any fall, I am ready to withstand it, and I am ready to put in more money at that point of time. So this is something, this typically happens at a little, at a real bull market kind of a scenario. The major concern from our observation is the large supply of paper. And this is probably more than other two concerns, this is a very major concern. Then that is a right investment. Now, if that company is available at 20,000 crore market cap, I mean, can I buy at 20,000 crore and make money? Or, in fact, if I have 20,000 crore, I can copy the business and will create it in next 7 years, probably. So, that's the way we do investment analysis, and that's probably the reason we have been able to protect the capital as well as give the better performance. So what I shared those data, I just thought take 2 more minutes and maybe then we can have Q&A. So you can see non-oil export growth over last, with spikes, the average growth is, the average export amount is at just $30 billion, and now it is declining. This is the BSE 500 revenue growth, which is sub 10%. So that is also declining. So these are early signals. I don't know whether this will go back up, but these are the signs which we need to evaluate internally. The wage bill, as I said, on the private sector and BSE 500, which is at 6-8%, which is too less. And this is across, not just IT. I think IT is hardly maybe 1 to 3%. And the last thing, that this is where we are currently from our market cap to GDP, what we had similar in 2007. I'm not saying this is to be worried or not to be worried. What here I'm trying to bring is that the good part today versus 2007 is that there was a lot of leverage in the system at that time. Today there's no leverage. People are so matured that they don't over speculate. They don't do over trading. They have discipline. They have capital invested into all the asset classes. So there's a distribution of capital. So that's a little better part today. And yes, as an economy also we are better off. And as corporate balance sheets are also very good as compared to what 2007. In fact, we have no concern of banking system issue in our economy today, what we have seen in 2007, or even the utilities or infrastructure companies. Today, I don't think we have any of those concerns. So here I'm not trying to say that this is a worry and then you should sell off and run away. What I'm trying to say is that these are the early signs of indicators, coupled with there is a little bit consumption slow. So still government can catch up. So if your consumption is going down, your export is not picking up, then I think government needs to step in a very big way. Unfortunately, currently, Indian government is also tightening fiscal deficit, which in my learning curve, this is the time they should go all out and spend. If the whole world is spending, why are you worried about your currency? Maybe your currency will decline by 3 rupees, but you should go all out and spend. Instead, they are tightening the fiscal deficit. And within the tightening of fiscal deficit, they are controlling the deficit. Within that, they are spending more on the social causes because of the coalition government now. So this is also which we feel that at some point government will realize once they see the consumption data. I'm sure the think tank is better today. But we need to observe and we need to see how they met. So overall, our view is that have a cautious approach and avoid extremely high valuation businesses with a belief that somebody will take it to further high. And do a due diligence, which is, and a long, really discipline. Discipline is required, patience is required. There is no hurry in the market. Always market is going to remain, and we have a long way to go. So one can observe things and then and see. And the last thing what I missed telling is that one needs to wait for US elections also, because who comes as president is also critical for the world, and that could change a lot from here on.
So I have a question.
Sure.
Thank you for the wonderful talk. For a new investor, would you recommend investing in a mid and small cap or large and mid cap?
Currently, I think large mid cap would be because that's little low beta. Yeah.
Hello. So you said the scenario is not very conducive for new investment. So what percentage of cash you are holding in your?
So I think good question. We don't look at what's the cash level. We are not God. We don't understand how the markets, whether it will fall, how much it will fall. FIs have been selling. We don't know. They will continue to sell more. Nobody knows what's going to happen. Tomorrow they may start buying. We just don't know anything. So though we have a cash of about 30%, 35%, I think, but that's not a cash call. We have not sold because we are seeing market is going to go down and I'm going to lose. What we have taken a decision or a call that the stocks which we have sold, we feel that my risk reward is not favorable from here on in those counters. So we are holding a lot of stocks. But we feel that reward from here is probably, let's say, the stock can still go up by 10, 20%. We don't know. No one knows. But we feel that if there is any kind of slowdown which it happens in the world and in India, because we are not an island economy that we are separate from the world. Of course, we are going to be impacted by the capital always comes from the world. So if anything happens, then my risks are high. So rather than taking and waiting for that another 10% or 15%, and second is we don't know whether it will come or not come. So that's a call, prudent call we have taken in exiting certain stocks. Some of them stocks we have not exited fully, but we had invested 4-5% have become 12-13% of portfolio because of the price increase. So in those kind of stocks we have brought down to reasonable safe level. So that's the way we are positioned. It's not we have taken a cash call hoping or believing that the market is going to fall. We don't know. We really don't know what's going to happen.
Hi, so this is a slightly digressed question, not really addressing what you've been saying, and thank you for the great talk, very enlightening. However, there was a discussion going on in the morning where Kamalji was talking about PMS versus AIF, and there were transparency that was discussed that, AIFs are typically more transparent in terms of taxation and other things, and Green Lantern PMS being, I think the entry barrier is 1 crore. I'm a recent investor with Green Lantern, in fact. So how do you see it, and how do you compare it?
Can you repeat? How do you use?
How do you see the PMS versus AIF comparison, given that the Green Lantern entry barrier is almost the same as an AIF?
I think that there's no major difference between PMS and AIF. The only difference, probably at our end, we don't have AIF as of today. But at PMS, what we are doing is we are not having a model portfolio kind of a operation. Whereas in case of AIF, it will automatically fall into a model portfolio. Whatever stocks are there, if you come at the current NAV, those stocks are going to be there for you. In our PMS, till now, we are trying to model for a new investor. We're not copying the entire portfolio. The reason being is that there could be few stocks which could be on our list of selling. Now, we don't want to punish new investor by investing today into that stock, and tomorrow I am selling the same stock from other accounts. So, keeping that, we are able to manage the, I would not say tailor-made, but we are able to manage the segregation between model portfolio and what is investable only we will invest. And over a period, both the portfolios become aligned. So that's what we are doing at our end. Maybe beyond a size, we will not be able to do that. But as of today, we are able to manage it.